Hey, it's Arthur here, and in this video I'm going to talk about the top founders mistake we do when we raise money from the banks. I'm Arthur Geisari. For 5 years I used to be a CFO for a big holding company, then I quit and started my own journey in entrepreneurship. Since then I've founded more than 36 companies, I went bankrupt, I recovered, and now I'm doing business credit brokerage in European market. So 5 years experience in the funding and 10 years experience in entrepreneurship. 36 ventures launched, and in total I have fundraised more than 100 million euros across 1,400 companies. And today I'm going to share the patterns that I see, and we wrapped up them in the mistakes. I think we calculated around 30 mistakes in total we as founders do when we go for the money for the banks. Usually the process of raising money consists of 5 different steps. So we call it 5-step funding blueprint, and this is the framework that we use for helping companies to raise money from banks across different countries. So it consists of 5 easy steps. First, you map where you are, then you define where you want to go, the point B, then you do your homework, then you build a lending strategy, and then you apply, negotiate, and win. This we teach in seminars and webinars and workshops, and this we apply when we do the fundraising mandates with our customers. So before moving further to the top mistakes, I just want to say that there are many banks. They are there, they're waiting for you. For 4,000 years, banking industry was there with lending money against goats and sheep and land and slaves when it was, just read the Hammurabi law. And in the worldwide, there are 25,000 banks. Only in Europe, there are around 6,000 licensed funding institutions. And if you look at their numbers, they're massive. Like in top 1,000 banks in the world, they hold $160 trillion in total assets, and half of that money is in the loans outstanding. So it gives you an idea that banks are earning money from interest on the loans, half of their revenue, and then half of their revenue is from the commissions. This is how banks works. So next time you think that banks are not interested to lend me money, read that again. Half of their income comes from loans. So banks like lending money. And usually they lend money to private people and to business. And in this channel I'll talk only about the business. So banks want to lend you money, want to lend money to me. Just they have the criteria how they assess the business. And it would be good not to make the mistakes in order to be fundable from the banks. If you want to go to IPO, most probably at some point investors or your partners would say, hey, you need to raise money from banks in order to have higher return on equity and more liquidity to grow your company. And then if you look in EU only, we have very healthy loans to deposit ratios. This is the ratio the banks like to have a look and use the money to lend money further. Okay, so what about the 5-step blueprint? So first you buy the scales. You stand down with them, stand on the top, and you see the numbers where you are right now, your revenue, your assets, your equity. This is very necessary step. Then you ask yourself where you want to go. What's the goal of my business? What's the goal of my venture? Then you have a strategy how to achieve the point B from the point A. Then you apply the strategy, you have the strategy, and then you do the homework in order to prepare for the strategy and apply the strategy. Right? Where we start, we always start with point A, where you are right now. Then we want to go to point B, where you want to go. Then you do the homework, then you make a strategy, then you apply and win. So this is how it works. And let's jump to the top mistakes you can make. So the first mistake the founder can make is not knowing the numbers. What are my revenue? Is it MRR, ARR? Is it quarterly, monthly? Is it top line revenue? Is it gross revenue? Is it net revenue? Is it EBITDA? What's the profit? What's the assets? What's the equity? So if you want to make it more simple, it's revenue, assets, equity. Those 3 numbers, the most key numbers you need to know. If I call you at the night and I say, hey, what's your revenue? You need to have an answer to that. If you don't have an answer, we have a big problem here. Second, not knowing unit economics. Yes, you heard me right. Most of the founders, they don't know their unit economics. They don't know what's their revenue, what's the fixed cost, variable cost. They don't know those numbers. And then again, how you can borrow money if you don't know how much money your customer, your unit is making. Then the third mistake we don't understand the cash flow and repayment capacity. We actually don't know how much money we're generating per month, because unit economics doesn't answer that question, right? So how much money we are generating per month, per quarter, how much money goes to the expenses, how much money is left in our cash flow, how much money from that money we can use to repay the loans or any project we want to go. Then the next one, we don't see the whole picture. Sometimes we have some unresolved issues with founders and cap table, with creditors, with some problems with employees, and we are not solving that, or we just don't want to see that. For example, a messed cap table. In one of my companies before, I had an investor from Kazakhstan, and I remember a bank closed our bank account because the guy didn't pass the AML of that bank, anti-money laundering laws. And when I was raising money with that company from VCs said to me, you have a toxic cap table. So then at least I knew what it was, and then I had two options, to talk to my co-founder about the changing the investor, so the cap table is much better, or raise money from private entities, private institutions, not VC funds, for example. So you need to maybe to solve your cash flow problem or cap table problem, but before knowing what to solve, you need to know where you are. Then maybe you have some court cases, some legal proceedings, some legal problems that you need to really address, and you need to know if you have them or not. Then maybe your employee turnover is much higher. So the metaphor I'm using, since I'm using my Marrakesh style jacket today, is like you're in the desert, you're blindfolded, but you're smiling, you think you're nice, you're naive, you're emotionally pumped up, you think you're the king of the castle, you're top of the mountain. I mean, use any metaphor you like, but you're in the desert and you need to move somewhere, you need to make something, and it's not that good. Right? It's not oasis, it's desert. So, and when you're mapping your current situation, emotionally it's not very nice. But again, these are the mistakes we do. Okay, so once you point where you are, you need to ask the question where you want to go. And again, we as founders can make few mistakes here. So first, there's no growth or development plan at all. Sometimes it happens that you're just working in operative mode and you don't know where you're going. No development plan for the company, no strategic plan, no tactical plan, no scaling plan. You don't know how much customers you want to have this quarter, this year, what's your employee plan, what's your capital plan. You have zero plans. This is the mistake. The next mistake is, even if you have a plan, you don't know the use of funds, you don't know the funding plan, the funding strategy. So what's your funding plan? What kind of money do you need? How much money do you need? Okay, let's say you need 1 million. Why? How much of that will go to marketing? How much of that will go to hiring the best people out there? How much money will be to buy the competitors? So you need to have a defined, clear list of things you want to buy, you want to invest money into. And again, it's very hard to know that, even to have a development plan. Then there's no clear goal for funding. So what it means? It means you don't know where you want to borrow your money from, or you don't know from which kind of type of investors you want to raise money from. First, you need to know where you are in your pre-seed, seed stage. Maybe you're bootstrapping, you don't need VC money, you need to bootstrap on your own. Maybe you need debt funding, I don't know. There are pluses and minuses for bootstrapping, for debt funding, for equity funding. In different cap tables, different structures, different liquidity possibilities, but you need to have a goal, an understanding, a vision, have all the options on the table. That the next mistake we do as founders is that we have no timeline. We think it's very quick. I have 5 calls and I close the round. No. For debt funding, remember, it takes from 2 to 6 months to close a funding round with a bank. Again, sometimes it could be 2-3 months, sometimes 12 months, it depends. For the equity, it's 4 to 9 months. This is the average. Some say 6 months, some say 12 months, but it's not 1 week. Yes, if you are in Silicon Valley, serial entrepreneur, and you have all these lists of private equity funds, yes, you can call them and close the round in 3 weeks. But let's be honest, if you're watching this video, most probably you are not there. So you need to be realistic about the timelines, how much time it takes. And the mistake is that we see that I need money yesterday. Remember, if you have that, you have the worst possible option on the table. Then another mistake is not talking to your partners, investors, and just blindly accepting their offers. I did that for myself when I had partners in my business. They were setting the vision, the strategy, and I was just, okay, let's go. Okay, so I was lazy to put my time into developing my own strategy. And second, I was afraid of talking to them and saying, but look, What about this? What about this? Maybe we don't go this country, go this country. Maybe we change the development plan. I was afraid to speak. Then another mistake is that having too big goal, too small, or unachievable. What it means? It means that the plan should be realistic to where you are. And I like to use the framework SMART. You can use whatever other frameworks you want. It stands for specific goal, measurable, attainable, realistic, and time bound. It means that it's specific. It's measured. It's very specific. It's detailed goal. It's very measurable. You can ask yourself a question end of week or month. Did I achieve it? And you need to have an answer yes or no. Attainable. Is it possible to attain it? Let's say I just found a company. 100% shares, zero revenue, zero assets, zero nothing. My business type is not VC fundable, and I have a goal to raise Series A. No, it doesn't work like that. And it's not AI, it's not that all that, very now famous trends. Most probably VCs will not fund me. Let's say I'm gonna have a coffee shop. No, it's not VC fundable. Maybe I can raise money for friends, family, fools. That's a realistic goal. But going to a bank without a collateral, without revenue, without possible equity on the table and say, hey, can you lend me money? Most probably no. Of course, there are some banks, state-owned government programs, some EU funding there's out there, but it takes time. So most probably it's more no than yes. So use that framework to have a clear goal where you want to go. And again, using your metaphor in the desert, you are in the desert right now. Why? Because you map your point A. You are in the desert. So the next goal, the next step is to understand where you want to go. And you have different options. You can go to the river, you can go to the oasis, you can go to the forest, you can go to the mountain. Here, I don't know what's the best plan for you. Usually when we work with customers, we ask that question, where you want to go, what's your plan? And then we map that plan against the financial numbers. Let's say I have 1 million revenue. Banks most probably will give me from 10 to 30% of the loan to my revenue, to my yearly revenue. So it's 100 to 300K. That's the realistic money I can borrow from bank just to get my revenue. Then I stack up my equity, my assets, then maybe the number change. So then I ask myself a question, okay, 300,000 I can get. Is it enough for me for this plan? Is it enough for me for this plan? Maybe I buy equipment. Maybe I rent equipment and put the money in working capital. So you get the idea. So you have different plans based on different options where you are and your situation. Okay, next we move to the mistakes in the funding strategies. So first, use only one funding strategy. That's the biggest mistake you can make. Having no funding strategy or using only one funding strategy. This is the biggest, I think, obstacle in not rejection, but handling the objections with the customers. I'm bootstrapping. I'm not interested in debt. I'm, VC fundable. I just raise equity. I don't need debt. Or there are some other crazy guys that use only debt funding, but they don't see options how they can grow with their own funds or with VC or private equity or angel investments or just the private people giving equity to them. So more options is always better than one option. Don't make that mistake. Second one, ignoring alternatives. There are many alternatives. Let's say I'm a SaaS founder. I have 5 million ARR, annualized revenue rate, and I'm just VC funded. So what it means there are financial instruments available to me like revenue linked agreements where I can raise debt funding tied to my revenue without giving out shares. I keep the shares, I have liquidity. Yes, it's expensive, but I grow my company because I can put all the money in the marketing, have more customers, more subscriptions, more revenue, more profit, more do. So if I ignore that, I'm actually being stupid. So ignoring the alternatives, it's not something very smart to do. The next mistake as a founder, and again, hear me right, I'm founder myself. I founded 36 companies and I made many mistakes. I think I made all of these mistakes. So I know what I'm talking about when I say we as founders. So we as founders, the next one, choose the wrong instrument for the business model. If it's SaaS based, we can use revenue linked model. If it's heavily asset based, I don't know, in steel business, on wholesale business, you need working capital. If you don't have strong asset base, most probably maybe a small credit line. If you have zero revenue, but just assets as a collateral, and you don't have a solid project to show for a bank, most probably it will be funded from tier 2 banks or alternative lenders who do the asset-backed financing. So it depends on your business model. Another mistake is that we skip comparing different kind of funding instruments. We just stick to one of those. It's similar to the using only one funding strategy. Because again, for the funding strategy, you can start with equity, then raise debt, then again raise equity, then raise debt. You can raise expensive debt, and then you refinance for a cheaper one. There are different types of strategies. And the fourth point points out that we're just skipping the numbers, we're skipping the comparison. Having the first option on the table and skipping and comparing all the different solutions is a very bad thing to do. Again, assuming fundraising is quick, I touched upon before, debt funding, equity funding takes time. It's not 1 week's achievable. Because you need to make your homework, you need to prepare, you need to pre-vet them and then make negotiations and etc. etc. It's a long shot. Again, another mistake, do everything alone. Don't get me wrong, your accountant needs to do the accounting. Don't rely your funding strategy on what your accountant is saying and thinking about your business. You are making the business, you're an entrepreneur, the accountant is doing his job, her job. Second, if you have a CFO in-house, sometimes CFOs, I remember myself, are not that experienced or not that knowledgeable in fundraising for the company. CEO should always be equity fundraising. This is my stand on that. For debt fundraising, you can do that on your own. You can give it to a CFO. But remember, when I was working in a holding company as a CFO, my job was consolidating balance sheets, making management reports and profit and loss statements and making budgets and reportings, but not fundraising. And I was going to banks. I didn't like that. I share many stories on my YouTube channel that I didn't like to go to banks, talk to them, because before that I'm scared. During the meeting with a bank, I shake and I feel very small because they're big and they have a lot of money and power, and they think I'm stupid, I have these mistakes and I have these risks. And after meeting with a bank, I have this feeling I need to close my business. This is the feeling every time I get to talking to a bank. So don't do this alone. Find someone who can help you. You can call other founder and ask how he's doing. Maybe the founder, the businessman who has more experience talking to banks, he can advise you, he can say what to do, what to not. But never do this alone, because time is expensive. Another mistake we do, because funding again is about the math and emotions. It's about letting the fear, the past experience, or experience from other founders, which is irrelevant these days, to drive your decision making. I give you an example. Around 1/3 of all founders that we work with at first call, at first meeting, said something like, I don't believe banks. I don't believe I'm fundable. Banks don't lend money. The economy is going down. The rates are going up. They have these fears, emotions, and patterns. How we tackle them? We give numbers. We say, hey, look, Euribor is going down. Interest rates are going down. Look at the banks. They're lending more money now than they were lending half a year ago. And by doing that, we decrease this pattern of irrational thinking. So remember that, don't let fear drive your emotions. And again, metaphorically speaking, you have advisors around, you have people with more experience around. You can look at my channel, you can listen to other guys, you can call your bank and just talk to your manager in the bank what he, she thinks about your funding strategy. Have as many opinions as possible, because the more opinions you have, the better decision you can make. Okay, the next stage. At the next stage, when we prepare and do the homework, the biggest mistake you can do is just ignore everything that people are saying to you. Let's say you call the bank, you call the partners, you talk to your co-founder, you talk to your accountant, to your CFO, you hire a few advisories, and then you just totally ignore. Let's say you apply to a bank gives you a rejection. Usually what we do on behalf of the customer, we ask for a bank, okay, give me a list of reasons why you reject the customer. And if we apply to 10 banks, we have 5 rejections. We get all the rejections in one list. What happens next? We give it to a founder, say, look, here's the rejection list. Now you do the homework. And the founder says, no, I will not do that. Why should I? They're stupid, I'm smart. Okay, this is the mistake. The next mistake is you don't clean up the financial structures. You do them some minor improvements. Let's say the bank said you have tax problems. Once you solve that, you can go get back. Okay. So you solve the tax problems, but you don't clean up the accounting, the financials, or the cap table, and then you come back. The next problem, the next mistake you can do is you deliver incomplete or late documents. So remember always, when you apply to somewhere, you need to respect the process, respect the timeline, and you need to be prepared. If you apply unprepared, it will be seen by the eyes of financial analysts, by the manager, by the client, associate, and it will make minuses than pluses for you. This is one. Second, if you send information partly incomplete, it just shows a bad signal. This is the mistake you can do. Another mistake, you assume that you're ready without fixing the weak spots, is the preparation. No, it's not. By knowing that you know your problems, it doesn't mean that you have fixed them. Another one is apply without homework. I did that by myself. I remember I sent a loan application to a bank when we needed a bank for a car rental company. And I just forgot that, they'll ask simple things like, okay, send me a operative balance sheet, financial forecast. We needed to buy cars. They ask what kind of car models you want to buy. I was just thinking, we need 100K, let's apply, let's see what happens. This is wrong, because by not being able to answer for the questions within the 1 week, I lose the momentum. This is what happens when you go unprepared. Yes, it takes time. Yes, it's boring. I remember when we run a webinar, I asked in a poll, how many of you don't like doing homework? 70-something% of founders, they voted, they don't like doing the homework. This is the boring stuff. Hey, it brings profit, it brings prosperity. Yes, you can do that Saturday, Sunday, or at evenings, sitting here with the candles, but it needs to be done. Okay, the next set of mistakes, it's in communication and process. So it's oversharing irrelevant information. I see that time from time when founders send us 20 documents, PDFs, Words, all the data room, everything is there, but half of that is not relevant for the, let's say, debt fundraising. They need different information. When you go to equity fundraising, they need different information. So that kind of information is irrelevant. Then second mistake is just telling inconsistent story or chaotic story or telling too much. No, bank or investor needs what he needs. They have specific set of questions. For the VCs, how did you came up with idea? What's your background? What the problem you are solving? What's the solution? How easily can you be copied? Or what's your funding plan? What's your exit plan, etc., etc. For a bank, it's the same, just in different way. What's your exit plan? For what you will repay the money? What's your cash flow? What's your projection for 5 years? What's your story? How did you start? And if you don't have that in one pager in your head, it will be a disaster. Another mistake is that you apply multiple times to the same institution without changing anything, and then you hope that something will change. Honestly, nothing changes. Why? Because they expect from you something new, something different. Numbers are changing, revenue is growing, EBITDA is getting better, finally get a positive equity. And you need to have pluses in order to apply or reapply. Another mistake is accepting the first offer. First term sheet from a bank, first term sheet from an investor. You just accept it, you go with that. What are the minuses of that? Drawbacks. One, you don't know if it's the best offer on the table. Second, it shows to the related party that you don't have other offers on the table. It's too quick. What signal it shows, right? Next mistake is you don't compare the terms across the lenders. If you made the mistake number 4, and again, another mistake, you apply just only to one institution, then of course you have no options to compare between all the other lenders. If you don't do that, then you have the worst terms possible in the world. Another mistake is you don't understand the true cost of capital. What it means that it's high interest rate. This is what we hear. 5% per year is high, I want 2. Or it's double-digit interest rate. 15, oh my God, 15% per year, it's too high, I cannot afford it. Well, the question I ask usually is, what's your unit economics? How much margin you're making? Let's say it's 5%. You see, my margin is 5% and the interest rate is 15. I cannot afford it, 3 times higher. Then I ask another question. What's your cycle? If your cycle is, let's say, 3 months and you have 4 cycles per year, it means in a year you make not 5% but 20%. It's 5 times 4, and you borrow at 15%. Okay, there's some overheads, commissions, etc. Let's say it's 17 annualized percentage rate. You still make 3% on the money you borrow. Plus you have more liquidity. You can buy more goods. You can negotiate lower prices with the suppliers. You can sell more goods and services. You can spend more on marketing. You can finally hire better people, better salespeople, better management, improve the business process. You have higher margins. Actually, by having more liquidity in the company, you can have higher margins by improving the business process. But no. 15 is high. This is the mistake we do by not getting into the numbers. Another mistake is fail to create competition between the banks. It's just applying to one institution and then hoping that something will miraculously happen. The metaphor here is you go to the marketplace and you start shopping. And when I mean shopping, you compare different products, different services, you compare the terms, because sometimes you borrow at a higher rate because you have a higher term. And your cash flow, your monthly cash flow is much better. So it's not only about the interest rate, but I can mathematically prove to you that term has bigger impact on your cash flow than your interest rate. Because borrowing money for 1 year or borrowing money with 10 year repayment graph is much better. It makes big difference. Okay. You can say to me, Arthur, okay, I understand there are 30 mistakes. I do them. Why do I care? Well, there are costs to those mistakes. I did those mistakes. I can sign for every point here that there's a price you pay. Just you don't see that in the day one. So first of all, you pay with very high interest rates. If you borrow when you really desperate in the money, it means I need it yesterday. Banks charge you premiums because they assess you and they understand there's high risk, because if you need it yesterday, you have poor financial planning and blah, 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 blah. So they charge you higher rates. Second, if you need it quickly, then it means you will most probably be borrowing from tier 2 banks or alternative lenders, which are just more expensive. Second, if you convert that to the money you borrow, you will pay more back. This is the number, from 50 to 500K over the lifetime. Next one is lost financing opportunity. If you don't raise the money, you don't get the liquidity, and you don't use that money to grow the company. Then you lose time. If you apply to banks and you don't know how to do it properly, you're not prepared, you're just losing time, and time is precious. Your growth delays. Look at your competitor. If you're looking this video and just sitting, Arthur, I don't care, I'm good. Look at your competitor. Look at your other competitors. Look at the top players in the market and ask questions. Are they using debt funding? Are they growing much quicker than me? If yes, do they have liquidity issues or no? Look at your bank account. Do you have enough money? If yes, then maybe you need to change your growth plan to grow quicker. So having more money on the table increases your chances of growing quicker and better. If you don't do that, you just delay your expansion. Your competitors will do. Another mistake is that you raise more equity than debt and you just risk of losing control. At some point, you give too many shares to investors and co-founders and other investors and friends, family, fools who got in the business and get the biggest share of the equity. You lose that. You can calculate, multiply by your value, enterprise value, and you will get the very big number of how much money you're just giving out, which you could just borrow from bank, have more liquidity. Then higher collateral requirements. If you are not well prepared, if you apply to the wrong financial institution, then most probably you will end up, or you are not comparing to many offers on the table, you will have the worst LTV requirements, loan to value, and you will just borrow a lower amount of money than you could have. And the refinancing penalty later means when you apply to a loan, usually in loan agreement, there's like percentage written. If you repay it before the term, do you pay on the top or not? If you apply to 10 banks and you have 5 offers, you can renegotiate that point to have it practically zero. It depends on the country where you are in the banking system. If you don't do that, you end up with a higher refinancing rate, which is painful. If you borrow 100 euros, 1% from 100 euros and 1 euro, nobody cares. If you borrow 100 million and 1% is 1 million, that's a big one. Then we have calculated then if a founder does debt fundraising on his own, on her own, it takes about 100 to 300 hours of extra time, of extra management time if you do that on your own. This is the mistake that you do, and the reputation costs as well. So banks remember you, they have the lists, they have the internal documents, banks share information about customers within their databases, not everything of course, they have the black books and gray books and etc. But don't be scared of that. But if you apply and you look stupid and silly, and the next time you apply you do nothing, you improve nothing, you again look stupid, I mean it gives you minuses, not pluses. So don't look stupid, do your homework. Okay, so what's next? So you have all these mistakes you can do, and if you do, you end up here. What to do? You can watch any of the YouTube video we have, and you can get the Ultimate Bank Funding Blueprint, where we have specifically prepared a book of how to fundraise money from banks. Or you can watch, we have now I think few videos on the website of how to prepare a winning debt fundraising strategy. And we have 5-step fundability blueprint also filmed and packed as a standalone masterclass recording. So you can get that on the website, watch it, and start improving your capabilities and possibilities of borrowing more money. Again, my name is Geisari. I'm an entrepreneur and founder. Subscribe to my channel. I'm sharing videos and information of how to raise money from banks, how to work with the banks, how to grow business using debt funding. And have a nice day.